Hello and welcome back to the Junior Markets YouTube page. If you're tuning in from YouTube, make sure to check out my website. I go over everything in this video along with a lot more topics. And if you're tuning in from the website, thank you for tuning in. Today's topic of discussion is going to be cap rates and what cap rates are all about. So this is going to help you with the REIT of the week. As if we go down to the REIT of the week, I plan on changing it tomorrow, Sunday the 17th. I found another REIT that I think could be a good investment opportunity. And the REIT that we'll be going over tomorrow, it'll be up on my website for about a week, and then it'll be on a document down below in case you want to check it out after then. They One of the reasons that I like them is because of the cap rates that they were getting overseas and in the US. And so we're going to go over what that means to help better understand it for the company and to help you better understand what it is overall. So if we head on over to the stock market tab, by the way, I moved the definition of REITs over into this tab on the more info. So if we scroll down, I put the cap rates here. I will be changing this to a doc later on once I get some more vocab words down. But today we're just going to be going over this. And to sum things up in a little short story, the capitalization rate, also known as the cap rate, is obviously used in the real estate world. So I put it under the definition of REITs because this is what it most pertains to. And so these cap rates, they're used to indicate the rate of return that is expected to be generated on a real estate investment. So you come to this through doing the net operating income divided by the current market value. And so, for an example, if a property has a cap rate of 10%, it will take around 10 years to recover your investment. Now, cap rates are best used for more mature buildings and offices and properties where you can better estimate the cash flow and the revenues that are going to come from that building, because a building in a growing area or a building with more volatile cash flows that's not in the city, or you might think might not have constant returns, will have differing net operating income and might have a more volatile current market value. And so it'll be hard to come to a conclusion of what the actual cap rate will be. So this is best used on buildings that you can more relatively measure the expected cash flow. And so this is going to be most used for REITs. So if we head to the stock of the day and then the REIT of the week, I will be updating this tomorrow. And the company that I'm switching it over to um, on Sunday, the 17th, they are utilizing cap rates to their advantage in the US and overseas. And this is why I'm going over this video now. So when I make a video on the REIT for tomorrow, if there are any questions about what cap rates are, we can get that all settled today before the REIT of the week tomorrow. So now I am over on Morningstar's website, and Realty Income Corp is the REIT I will be going over tomorrow. I'll be doing a deep dive on this company, including how they make money, their business principles, and why I like them. But for now, we'll just be sticking with the cap rates. And so as we go down, we can see that the investor analyst, one of the key things that they pointed out were cap rates. So I'm not going to use their examples. I'm going to use a different example. So mostly when it comes to cap rates, the cap rate can be used to determine the riskiness of an investment opportunity. So a higher cap rate implies a higher risk, while a low cap rate implies a lower risk, because a higher cap rate, like we said, 10% would take 10 years, whereas a lower one with 5% would take around 5 years. So the cap rate, obviously, like all other metrics, should be used in conjunction with other metrics, and you should never just be looking at the cap rate because, like I said earlier, it cannot always be correct because cash flows and the market value of properties can change and can be very volatile depending on where those properties are, whether they're in a rural area or in. All right, so finally, let's hop into a quick example. So we have three real estate properties here, and property one, two, and three, they each have an annual income and a market value that we will use to get to the cap rate. Because, like I said, you use the net operating income divided by the current market value to get to the cap rate. And so the annual income for property one is 100,000 and so on. And then the market value is 1 million. So if you do 100,000 divided by 1 million, you get a 10% cap rate. And that's what I did for all of these. So as you can see, property one has the highest cap rate. Now, when it comes to choosing properties depending on cap rate, whether a higher or lower cap rate is better really depends on the investor and their risk tolerance. So a higher cap rate means that an investment holds more risk because, like I said, a higher percentage means it would take longer for that property to pay itself off, whereas a lower cap rate means an investment holds less risk because it will take less years to pay that off. But the higher percentage might come with more risk, but it might also come with a much higher return. So if you're willing to take on that risk, then so be it. And then a good cap rate, according to Investopedia and some other websites, is anywhere from 4 to 10%. It's really just how much risk you want to be involved with. And so now we can just go ahead and sum everything up, and I'm going to head back over to my website to do that. So finally, let's just sum everything up back on the Junior Markets website. So to sum up the cap rate that's used in the real estate world to indicate the rate of return expected to be generated on a real estate investment property. And then, for example, a cap rate of 10% means it will take around 10 years to recover the investment. You get to the cap rate by doing the net operating income divided by the current market value. And then some other things are the cap rate can be used to determine the riskiness of an investment. A high cap rate implies higher risk, while a low cap rate implies lower risk. And then the cap rate, just like every other metric, should be used in conjunction with other metrics. You should never use one metric alone, as one metric cannot tell a story of a company. And so this is our video on cap rates. And like I said, this will be useful for the REIT of the week that I'm going to post tomorrow. So thank you so much for watching. And if you're not already following us, make sure to check out Junior Markets on all these platforms shown at Junior Markets. And if you're coming in from YouTube, make sure to check out our website. I showed it in this video, but I'll go over a lot of these topics and more if you're a beginner in investing. And I will be posting that read of the week tomorrow, so make sure to be on the lookout for that. Thank you so much for watching.